Good afternoon and welcome to the EPS Business and Banking Dialogue online talk show. My name is KK. I am the moderator of today's show. With me today is Mr. Udayan Goyal. Udayan has already come before. Udayan specializes in corporate finance and strategic advisory in financial technology. He's a co-founder of Apis and Anthemis Group, the first specialist global investor in fintech companies. His investment include in technology-led companies such as Simple, Betterment, and True. So, ladies and gentlemen, this topic is of utmost importance in these trying and uncertain times. Financial institutions have been providing commoditized products and services. They are struggling to provide customers with differentiated value outside their service. Most banking executives recognize that one of the major sources of differentiation is the customer experience. In the past, the banking experience has relied heavily on branches to create a personal one-to-one experience. But as consumers flock to digital channels as their interaction point, banking executives need to find a meaningful way to build a relationship with customers in a different environment today, which is the digital environment. So wellness, which is both financial and physical, is quickly becoming a theme to win customers. So let's pay attention and understand from Udayan how these two wellnesses are converging to make our wellness as a priority. A warm welcome to all my participants across EPS platform, YouTube, Twitter, and Facebook, the Business and Banking Dialogue with Mr. Udayan Goyal. He is live today with us from London. Good morning, Udayan.
Good morning, KK. How are you? Sorry, I'm hoping. I think we lost it. But good morning from London. Hope everybody's well. Yet another week of coming through the COVID crisis. I think what's interesting is that for those of you who don't know, Europe is now starting to open up pretty significantly. We're starting to see that across pretty much every market, including the UK. I think we'll see over the next few weeks how it'll go, and I think that's a good segue into today's kind of discussion topic. So as KK mentioned, one of the things that we are looking at now more holistically is the concept of wellness. Wellness is a sort of concept where our own attitudes, etc., are driven by the way we feel. As many people know, the single biggest contributor to death is stress. And stress is really driven, and controlling stress is really driven by wellness. So the opportunity to think about wellness in a more holistic fashion has created a real evolution over the last few years as people think beyond siloing wellness between the concept of physical wellness and financial wellness. A quick pulse, if you go and talk to most people, and particularly through this crisis, is that people feel very stressed about money affairs. Generally, they look very carefully about how to manage money, how to think about money, how to manage risk, and that is a very big contributor to managing stress and managing how people think about stress. So from that perspective, I think we are increasingly looking at wellness not just through a physical lens anymore, but through this concept of a financial lens. And there's now the idea that there is a continuum between physical wellness and financial wellness, and really across four kind of sub-verticals, the way I think about it. Sort of health insurance, which connects very significantly into health, life insurance, which then connects again into the health insurance side, and finally asset management. So as you manage your savings, really to think about managing that in the future. So I think this is how how broadly we've been thinking about the whole concept of wellness. And I think the financial services industry now is starting to embrace this concept very, very strongly and very, very quickly. So I think that's sort of a broad introduction to the topic.
Yes, thank you so much, Udayan. So let's look at the role of banks and other financial institutions. So their new age customers are demanding much more than merely accepting deposits and managing payments. They are demanding well-being or health in both financial and physical. What factors are driving this trend?
So I think there's a realization, as I mentioned before, that there is an intuitive and actually well-proven scientific connection between financial wellness and physical wellness. So I think
Yeah.
you have to think about it two-sided: the demand and the supply. On the demand side, the customer behavior is changing. So if you look at the millennial generation and how people think about wellness, they are thinking about it in a much more holistic fashion, and wellness has actually become a very important topic amongst the people, amongst that generation. So this is actually an important way of thinking about how people starting to manage their lives, and that's the demand side. So as the demand side says, I need to think about wellness in a more holistic fashion, the supply side needs to keep up. And that's where the evolution of the financial services industry is starting to think about wellness more holistically. So as an example, there's an interesting business in the US called Happy Money, which I'm invested in, and it's a debt elimination platform. So one of the issues that, for example, a lot of people have is that they tend to be over leveraged. They have a lot of debt, and it's proven that people with significant money problems develop PTSD type like behaviors, which is post traumatic stress syndrome type behaviors. So understanding that physiological well-being is not only essential to make people feel better, but also, interestingly enough, is a very interesting tool to credit decisioning outcomes. So, Happy Money's basically used that science over the last few years and built a business around it, because it collects kind of the behavioral, attitudinal, transactional data, uses that rich data set combined with now increasingly machine learning and artificial intelligence, and enables a completely new way of scoring people from a credit perspective. And it outperforms all the traditional scoring metrics. So you start to see a real scientific basis for this connection between the two, but it obviously gets much, much deeper than that as we move into these other verticals.
Okay. Thanks, Udayan. So I think Udayan touched upon PTSD, and in these trying times, I think that
I think we're having a little technical issue with KK. Hopefully, he'll be back. I mean, while he's coming back, I'll just continue a little bit on, I guess, some of the some of the interesting scientific facts that are coming out. So, some of there are a number of metrics that can affect credit risk, as I was talking earlier. One of the things that coming back to the Happy Money example is something called the happiness index, and that's a composite measure of customer responses to things like gratitude, consciousness, and emotional stability. So this concept of actually mental wellness features heavily into financial wellness and how that happens. So this is actually quite interesting. And because Happy Money provides a platform for consolidating and restructuring all credit card debt and using automated advice and coaching, they can rehabilitate people from that perspective. And it also becomes a very interesting social responsibility aspect of actually helping people through that indebtedness. So this is actually quite interesting. It moves them from becoming habitual borrowers to systematic savers, which from a behavioral perspective is important. It's also very important from a wellness perspective, because as I mentioned to you before, wellness is really a state of mind as much, which then feeds into the physical. And that goes even back to ancient Hindu and Vedic philosophy, down to yoga, and why the mind and the body are so interconnected. So I sort of almost feel like the pioneer of this is actually right here in India, as opposed to anywhere else in the world.
Right, Udayan. Sorry, I was thrown out of the network for a while. So I missed you, but I'll catch up on whatever I missed. So, so I, to continue with our discussion. So previously, achieving this kind of financial well-being was a matter of personal responsibility and prudence, I guess. But with digitization, it is time to demand improved services and options from banks as well. So let's talk about digital data. There is an exponential increase in digital data. How does digital data enable banks to partner with, with partnership, like we are now talking of partnering with insurance companies uh, to create and generate shared value? How does that work using digital data?
So so you need to take a step back and really think about how one uses data, right? So what are we ultimately trying to do? I touched on the happy money example. I touched on credit, right? What is
Yes,
credit? Credit is
yes,
risk, right? So ultimately, at the heart of this wellness continuum and ecosystem is the concept of being able to track and measure risk better. So let's start with that. If you are, let's say you're wearing a wearable device like I am here, which collects and tracks my data because I use it to kind of manage how I feel and how to exercise every day, things like that. Let's say that's collecting some very bespoke data to you, which then you
yes,
can use it to assess risk. Now, that's quite interesting. That as many of you know, there are platforms like Discovery Health, which started in South Africa and now has become global, which
yeah,
which allow you to reduce your health insurance premiums if you provide your tracking data or you provide other data if you go to the gym more often, because there's correlation between the fact that you wear these devices and collect the data and go to the gym and others, and better health, which means lower insurance premiums, health insurance premiums. So what they're doing is now starting to correlate your specific risk, right, to specific data that belongs to you.
yeah,
Now, as we get into an IoT, Internet of Things, the highly connected world, we can collect very, very detailed data
yeah,
on your own behavior, on what you do, and others. That then can feed initially into, as I was giving you the example, health. And of course, that same data should feed into life because your life expectancy is largely correlated to how you manage your health. And so if you have all of that, then you can actually start to think about more granularly measuring and actually
yeah,
pricing risk for life insurance. And then that in itself, it becomes a tool for asset collection. So basically collecting long-term savings, which feeds into the asset management side. So that's how you start to see this continuum that
yeah,
at the core of it is the data, your data that you can provide in order for this analysis to be done. And of course, that's, as I mentioned before, it's enabled by artificial intelligence and machine learning because we have these technologies that allow us to really process this data in a very, very
yeah,
meaningful and also very, very quick fashion to provide these sorts of solutions back. So I think this collaboration, coming back to your question, Kiki, this collaboration, I think
yes,
you're going to start to see through something we talked about previously, open banking, data interchange,
yeah,
APIs
yeah.
between institutions where you can pull that data, start to analyze it, and look at it on a more holistic ecosystem-like basis.
Okay, thanks again. Yeah, I did read about the South African bank, Discovery Bank. They are using a platform which is, they call it as the Vitality platform.
That's
Okay,
right.
wherein they're bringing in all sorts of financial incentives to help customers curate and sustain healthier lifestyles. I think it was fantastic, and I think they're offering 100% cash back on gym membership. Which is like never heard of. You get your entire membership as a cashback from the partners who are in the who are with them, right? So that's great. So we had a lot of a lot of subject matter experts in the show who had come and talked about as wearables as the next big thing, the next big thing that's going to happen, and that financial institutes need to create partnership with insurance companies and others. So besides Discovery, do you see any other bank using wearables or and IoTs to kind of come out with products?
Yeah, I think the wearable, I think you're starting to see that in many markets. As I mentioned before, Discovery was the pioneer of this with Vitality, but you've had many innovations. There's even a company in India called Goki, which is a wonderful company which I've known for many years, set up by a guy called Vishal Gondal, and he's like, he comes from a gaming background because he set up India Games before that. And interestingly enough, there's a lot of gamification, as you mentioned, involved. Gamification is creating incentives through usage of that data. So
Yeah,
how
yeah,
Discovery gamifies behavior to improve health is, for example, giving back the gym membership because they want you to use your gym membership. Because what you see with the Discovery Vitality portfolio is that the cohorts that are doing that has significantly healthier, have much lower mortality rates, and therefore their profitability as an insurance company goes up significantly. So, this is what we're starting to see very much. And so, for example, I think Goki is partnered up in India with Max Bupa.
mhm,
So they're already starting to think about how to do that. And I think you're going to start to see this right across where increasing Discovery and Vitality have now spread to many other countries. Here in the UK, they're in the US. They're in many markets, and other people are starting to emulate that strategy. But I think it's starting to become much deeper. So wearables, I think, was really the first step in that journey.
mhm,
The next step in that journey is to start to collect disparate levels of sensor data. So you can start to really pick up data from all sorts of different sensor processes. I mentioned, I think previously, for example, with smart cities, when you drive your car, the sensors will be able to pick up your route. Your smartphone will be able to pick up your driving behavior. Your smartphone actually sees everywhere you go, so it can assess whether you're going to risky places or non-risky places. As you've heard in the COVID scenario, people are even using smartphones to do track and trace. So you
yeah,
can start to collect all this kind of data and start to put it together to refine risk analysis, and obviously to deliver products on the back of that refined risk analysis. So I clearly see a significantly greater use of data. And as I mentioned previously, you obviously have to temper that with some of the issues that are going to come up. And probably the most significant issue is going to be managing data privacy and managing cybersecurity and risk of that data being breached, because we see data breaches becoming
yeah.
more and more significant. The other issue in all of this, of course, is that one of the things that insurance companies and health insurance and life insurance companies and
Seems to be having some technical problem.
Yeah. So am I audible?
You're audible, you can go on.
Yeah, I think we wait for. I think Udayan's network is not working, I think.
Kumar, you can share your insights.
Okay. So while we wait for Mr. Goyal's network to come through, I mean, this is while we all are in these days into various online mode, but we are totally dependent on network connections, electricity, etc. So that's the problem, and right now even I have some power fluctuations. So we'll wait for Udayan to come, and we continue with our discussion in this matter. But clearly, I think two things are emerging very clearly, that the healthcare as a word that we used to use, which would mean only uh, physical healthcare, that's kind of changing. Okay, and it's the terminology called health is being used, which means not only your physical health but also your financial health. Okay, both need to be managed, and I think for what Mr. Udayan has been talking about, we have gathered that the banks and other financial institutions are actually now looking at leveraging digital transactions such that they can offer bundled products.
Yeah, we have start getting into a network problem. Um, Meanwhile, for the US, I have an input. Keeping this one in view, the Ministry of Finance way back in 2015, and the early 2000 basically opened up the banks to, at least the PSU banks, to open up in the insurance sector, which means that they were both bothered about the financial health as well as physical health. So that was one of the reasons many of the banks got together and started their own insurance companies. And that was basically one of the few things that Indian financial ministry tried to do that. I will wait for basically Udayan and Krishna Kumar to join. Meanwhile, I think you're going to stay put. Thank you.
Hi. KK? Sorry. Sorry, KK, I can't, we can't hear you.
Yes, can you hear me now?
Yes, it seems to be having some technical difficulties today, but we're back again.
Yeah. Yes, okay, we're back again. So, okay, we were talking about the importance of data, and while you were not reachable, I did talk about what does this convergence happen, and then I was also thrown out of the network. So now we are back. So before we go into the importance of, we have covered in the importance of data, and if you have data, you must have artificial intelligence. There's no doubt about it. That's the way things go today. So we'll talk about artificial intelligence, but before that, let me request all the participants in the show. Extremely sorry for this breaks in between. It's happening a little bit. The first time we are experiencing such breakdowns, but that's the way of life. Can you please go ahead and put in your questions right now, rather than waiting for later on period, so that this we can take it across to Udayan as soon as possible. You also have the opportunity to kind of ask a question directly to Mr. Udayan, and it has to be relevant to this to the topic that we are discussing today. Keep your answers short, so that many things we can accommodate many other participants. So please send in your questions as soon as possible. So let's talk about artificial intelligence, Udayan. Can you illustrate with examples how companies are forging partnerships across sectors and use artificial intelligence to offer financial wellness and physical wellness?
Yeah, so I think I've used this example once before, right? And I think the best example for me is a insurance company in China called Ping An. Ping An is an incredible company. It It's really not even that old. Was set up, I think, around 20 years ago, and it's probably now the best known insurance brand in the world. So headquartered. So it's ranked 7th on the Forbes Global 2000 list in terms of companies in the world. It's China's largest insurer, so $107 billion of gross premium income. Market cap, I think, is like in excess of 25 or 30 billion dollars at the moment, which actually makes it the world's largest insurer, with the exception of Berkshire Hathaway. But as you know, Berkshire Hathaway is much more of a conglomerate. And what Ping An has done, quite interestingly, is Ping An has built this ecosystem approach, as you talk about, right? This ecosystem approach. So what they do is they play in multiple verticals, and they play in multiple verticals with partners. So what by doing that, they can collect disparate sources of data, and they form a 360-degree customer view. So through that, so for example, they'll do they do profiling around 3 verticals. Customer profiling, so that includes things like your gender, pre-existing conditions, name, all the usual, your birthday, stuff like that. Your customer behavior, which is really your lifestyle, your social life, preferred service channels, your consumption habits. And then customer value, which is, services, products, service assets, things like that. So and then they're doing some very deep segmentation of that data, and using that data to build models, and then to deliver and customize insurance and wealth products that are delivered to you. And they'll do that through a very multi-channel approach, right? So they'll essentially be able to deal with you through many different channels. Now, this 360-degree view, they've created something called the Ping An One account, and in that one account, you can basically manage everything. You can manage finance, you can manage healthcare, you can manage your entertainment, you can manage your housing, you can manage auto, you can manage your insurance, and it even has a peer-to-peer asset exchange built in. So by doing all of that, they've really built the ability to really holistically manage through one point of contact. And this is a very important theme, because increasingly where financial services companies are going to be able to sell or product, and we've talked about that previously, it has to be embedded product. They are going to have to do it very contextually, and they're going to have to do it at the point of engagement. And so what Ping An has done is created a very powerful point of engagement through a value play to the customer. So, and they've really built it across broadly 2 verticals, but of course much bigger, which is the financial vertical and the healthcare vertical. So they've really done that. Now, just to give you an example, on the healthcare vertical, Ping An provides you to access to an app which allows you to access doctors on the app. They obviously provide you social health insurance, which is which basically is a different type of health insurance. They also have an entire auto vertical where there's an auto owner app, and there's a mapping app, and so everything that you need around your car. So it's basically empowering their core business, which is insurance, but the use of other technologies and partnerships. Because a lot of these applications and others are actually partnerships with other providers that are plugged in to their ecosystem. And this is important because if you look, McKinsey has predicted that the revenue pool in 2025, and I think this is US only, but gives you an idea of the global revenue pool for wealth and protection, which is insurance and banking and the services you talk. That entire ecosystem, for example, is going to be worth $1.1 trillion in revenues. The health ecosystem in for 2025 for the same period is going to be worth 6 trillion. The housing ecosystem is worth 5 trillion. The mobility ecosystem is worth 2 trillion. The travel and hospitality segment is worth 3.6 trillion. So all of this shows you that, if you can move your relevance out of just your own ecosystem into some of these ecosystems, you can actually increase your profit pool significantly. And so this is the reason people are starting to play in these different ecosystems.
Yeah. Okay. So that's a huge transformation that we are seeing. I think Ping An is Ping An One, the product itself is bringing across so many the things like you said, financial, healthcare, entertainment, housing, loans, etc., all put together into one aspect. So here also the like if you look at healthcare, the policies are issued by the insurance company. So obviously the customers are or of the insurance company. So does Ping An have access to the entire portfolio of the customer?
Well, I mean, this is where obviously there's a bit of gamification there, and there's also a bit of give and take, right? So one of the things that people are starting to do is contribute their others. So let's say you have multiple insurance products and multiple accounts, right? So there's a business in China that we looked at called BXB, and that's quite interesting. What they do is they using WeChat, you
Yeah.
basically you interact with them in through a chatbot, and what it'll do is it'll ask you for all your different insurance policies and everything. The idea being that if you contribute that data, the AI system can actually give you the best recommendation for what you should be buying. And I think people do that because they're looking for that solution. And so
Yes.
that this concept of aggregating that data to get a benefit, and that's where the gamification and the mutual benefit starts to come out. It started to become more real. So that's, I think, how people are starting to pull that kind of data in. So it's quite interesting how some of these businesses are starting to really think about data in these disparate ways.
Yeah, absolutely. So the digital data and the artificial intelligence is seemingly that demonstrates how a financial institution and its customers can mutually benefit from a greater financial well-being. And I think Udayan has given the example of Ping An and also Discovery, which is in South Africa. So I think these two demonstrate that you effectively can utilize the two, that is data and artificial intelligence, to as a win-win situation for you. So Udayan, then the question comes to a mind. I'm sure all participants must be thinking. So a diverse digital banking ecosystem of bank and non-bank players is emerging. That's very clear. Fintech companies, insurance companies, etc., banking, they're all coming together. So the question is the traditional banking model breaking apart?
The traditional banking model for sure is breaking apart. As I've talked about this before, I think the concept of selling product,
Yes.
financial product to customers is not something that's relevant to the new generation, to millennials and future generations. It's just not relevant. People don't consume product, they consume experiences. So the financial product needs to be embedded in the experience that they're consuming. You don't buy a mortgage, you buy a house and then you embed the mortgage within the house. So it's a whole different approach. So you have to move the mindset from a product-centric approach to an experience-centric approach. And then I talked a little bit earlier about engagement and the engagement channel, and they'll consume through that engagement channel. And the people who have the sort of the strongest engagement channels to customers are, interestingly enough, the technology companies. So it's actually the technology companies who are first and foremost. And in some markets, it's even the ride-sharing companies. So I talked about this before. You have GoCheck, or Grab in Southeast Asia, and they're increasingly become super apps that sell everything to their customers because they're a point of constant engagement with their customers. So I think that mindset changes, and of course, it has a huge transformational effect on the financial services industry.
Okay, thank you. So I think we have got good insight with data and artificial intelligence that is actually transforming the way banking and financial institutions provide service. So we will now move into the role of the account aggregators. But before we do that, like I said to all my participants, please put in your questions. So Udayan, I have the first question for you, and it looks more like the Indian environment. So, but it could be parallelly taken across the globe. So many insurers like the AIG and Edelweiss General have come up with specific plans where they charge car insurance premiums based on your daily car usage rather than just a flat fee. It's based, your premiums are based on how you are using your car. What is your usage? What are your views on viability of such products in the Indian market?
Look, I think these products are not only viable, but they're easily executable, because ultimately all you need for that kind of a situation for cars and car insurance, that's what we call pay-as-you-go car insurance or on-demand car insurance, is some form of tracking application. And guess what? We all have one in our pockets. It's called a smartphone. So as long as you have a smartphone, and you can absolutely do that, and that's really where the world is going to go. In fact, interestingly enough, because of COVID and because a lot of people hadn't been using their cars through this crisis, a lot of people are now pushing, saying, why should I be paying a yearly insurance premium when I haven't even been using my car for this whole period? So I think a lot of people will very quickly moved, or be certainly interested in moving to these sorts of on-demand products using data that comes from our smartphone. Feel like we might have lost KK again. Let's give him another moment. So while we're waiting for him, I guess the other area where on-demand becomes very interesting is in all aspects of our life. So on-demand risk, I think, is going to become an increasing feature that we'll see. It's going to be driven by, as I talked a little bit before, this concept of Internet of Things. The Internet of Things is going to be something that you will see become very pervasive as we move into very connected devices across the world. And as we move into areas where we are able to basically connect, let's say your refrigerator can be connected to the internet, we're starting to see a lot of that. And so there's going to be a lot of on-demand payments that are going to be made, and there's going to be a lot of on-demand risk that's going to be measured. So we're going to start to see quite a bit of this. So I think that's some of the areas that one should be thinking about as we go forward. And that comes back to the point of how the banking industry starts to get very transformed. The banking industry starts to get very transformed because they have to plug themselves into this new ecosystem. Without being in this new ecosystem, I don't think they're going to become long-term viable unless they become very specific niche players. So that's certainly something that we're going to see more of. So I don't know if KK is back. I'm feeling we're still having a few technical difficulties here. So I know that.
Yeah. So can we move on, Udayan, to the other questions? So I have a question. According to you, how significant is the role of account aggregators for personalizing value propositions that enhances financial wellness with the physical wellness?
Look, account aggregators frankly, account aggregators are 1.0 of a ecosystem that's now moving from 2.0 to 3.0. Account aggregators were just the initial, were just demonstrating the initial way of being able to pull data from what was previously closed data silos, right? So you had banks and insurance companies that had financial data on you. The account aggregators came and sat on top and wrote into all those institutions and pulled the data and aggregated them and could give you a holistic view of all your different accounts in one place. Now, we've talked about this in previous sessions. We have open banking and Payment Service Directive 2 and other such pieces of legislation around the world, which force financial institutions to create standardized API-based infrastructure on the top, which allows you to pull that data. So the role of an account aggregator in a future scenario is falling away quickly, is going to get replaced by people who build unified API access to all the underlying accounts. And then anybody can pull all that data and use it and mix it to do other financial products to customers. And the guys who are going to do that the most are going to be the technology companies. So I think that's how you should think about the evolution of the ecosystem.
Right. Thanks, Udayan. I think KK is back. KK?
Yeah, thanks. So sorry, Udayan, about this breaks. So I think we also we have covered data as a digital data as well as artificial intelligence and aggregators, the three important functions that go in the convergence of physical and financial wellness. So business models based on platform banking and digital ecosystems, are based on collaborative partnerships, right? So what are the key difference in types of partnerships in each of the two business models, that is platform banking and digital ecosystems?
The partnerships are broadly the same. I mean, you have to think about partnerships as the value chain, right? What is the
Okay.
value chain? The value chain is you have manufacturing, you have distribution. So those are the the two biggest parts of the value chain, and then everything that feeds into that, right? The raw materials come into the manufacturing. You then manufacture the product, and the product is then goes through a distribution channel and out. I talked about this analogy previously. If you looked at General Motors in the 1950s, General Motors was a fully vertically integrated organization. They even had, I think, they even owned steel mills, right? And they used to make the sheet steel, the steel. They used to then make it into the car. They used to build all the components of the car, assemble it, and they used to own the dealerships, and then used to come out to the customers, and they did all the R&D, sales, everything. Today, car companies are only R&D and sales organizations, right? Everything else is outsourced. Every piece of the car is outsourced to a
Yes.
manufacturer, right? Apple is the same. They're basically doing the design, sales, and marketing function, right? And so I think you have to think about it pretty much there. The platform-based approach is essentially that you're going to play in one particular part of that ecosystem. And as you move to a fully digital ecosystem, which, by the way, financial services should natively be, because financial service is not a physical product, right? It's a digital product. So it
Yeah.
should go through a fully digital ecosystem. You'll have to have these different parts. And the difference is that an insurance company or a bank in the 1950s used to be fully vertically integrated. Today, they're going to have to stratify into these different areas, which is the sales channel, the distribution channel, the manufacturing, the raw materials, which is the balance sheet. So
Yeah.
you see this breaking down in each of these, stratifying, and then you basically have the different parts talking to each other through these APIs.
Very well. Thank you, sir. So we have a question from one of the participants. He is interested. He says, if you could explain a little bit more on the partnership of Goki and Bupa in the Indian environment. And so he's also asked, is Goki a new player in the current environment?
So I think Goki has been around for quite a few years. It's a company that's been around for quite a few years, and I think what they ended up with doing a deal with Swiss Re. So what Swiss Re allowed them to do was essentially take the data that was collected on the device and benchmark it and correlate it with risk and create a sort of reinsurance package for a health insurer that allows them to reduce that cost, and then you can pass that cost to customers. I think they did. Max Bupa essentially entered into a three-way partnership with Goki and Swiss Re for India, and therefore the Max Bupa policyholders would get access to this wellness engine, which includes health coaching and health management, and which is all part of the Goki platform. So I think that exists today, that's out there. I don't know, I haven't kept up recently with how well that partnership is doing, but that's broadly the concept of the partnership.
Okay, right. So another query based on the same this one, maybe you could answer, is that the leading four top companies or IT companies in India, are they? Do you have any idea, insight as do they have any plans? Have they already tied up with any of the insurance companies and others to offer it as a bundled solution to the banks?
When you say the technology companies, I'm thinking more of consumer internet companies. So, a good example would be Ola or others. I think they're all contemplating how to enter. I know that Uber, for example, has partnerships in the financial services space already. So they offer, for example, prepaid cards to their drivers around the world that allow the drivers to receive the money directly onto the card. So that becomes kind of a current account. I think on a more global context, I mentioned before, somebody like an Amazon has a partnership with JP Morgan Chase for a current account. It has a partnership with Berkshire Hathaway on the insurance side. So Apple has a partnership with Goldman Sachs on the card, the Apple credit card. So you're starting to see these partnerships between the technology companies proliferate across the world. And we'll continue to see it everywhere, and it'll eventually come to every part of the world.
Okay, true. Okay. So there's another question on the data privacy problem. Okay. So we talked about Ping An as an example, where you said that they do a customer profiling, gender profiling, behavior, customer value, etc. So which means all about the customer is kind of profiled by this institution. So does it clash with the Data Privacy Act? And if so, are there any measures that Ping has already taken?
Well, I think all of these examples, people are very careful about data privacy. In Europe, you have a very stringent data security provision called GDPR. And GDPR requires explicit customer consent, not implicit, for the use of data broadly. So it's a pretty strict data standard where you need to seek customer consent and do it. And the penalties for breach are very, very significant. You are going to see exactly the same laws all over the world. And companies have to comply with the laws, and they build systems and processes in order to comply with the laws. So, you often, when you're going into your browser or something, you get Google to ask you to accept terms and conditions. And those terms and conditions are essentially Google saying that you're allowing me to use your data. Now, many of us don't read it, but that's not the point. The point is you have consented once you've clicked that accept button. So it's your own responsibility if you don't read it. So increasingly, I think people will be more careful about reading things like that and making sure that they are providing their data in a way that is consistent with their understanding. And that's the way you have to architect your product to be compliant with regulation. And that's why regulation is so important. So I think Ping An is no different. Ping An is very much compliant with the regulations in their home country. And they will use that data within the regulations that and how they're allowed to use that data.
Yeah. Thanks, Udayan. Another query that has come my way is about you mentioned about happy money reach. So a participant, not mentioned his name, wants to know which banks have they tied up with, and are they or do they offer similar systems or services like Ping An?
No, Happy Money is not so happy. I was trying to give two examples. Ping An is a very insurance-centric example. Okay. So the core of their business is insurance and savings, and that's what they're driving to. Happy Money is, as I mentioned to you, is a debt consolidation platform. So what they do is a lot of people it's a US company. A lot of people in the US have very significant credit card debt, right?
Yes.
So and credit card debt is very expensive. Typically very high APRs. So what they're trying to do is help people take all their credit card debt and consolidate it and refinance it with a cheaper loan. And they do that. They initially did that on a peer-to-peer platform, but now, like any balance sheet driven company, they have multiple sources of liabilities, right? So they have bank partners, they have fund partners, they have other people who basically lend into the platform to the customers that are taking that consolidated debt. Conceptually, it started out as a peer-to-peer platform, but it's become much more than that. So it's a very open platform. Anybody who wants to lend into the platform can basically lend into the platform, any institution. And by the way, that's kind of where I think a lot of financial services companies are going. They're not going to be able to originate assets anymore because these platforms are the ones that originate the assets. They're going to have to plug themselves coming to the platform point into platforms like this in order to essentially source assets through these platforms, because ultimately they have liabilities, which are bank deposits and others, where they need to earn a return if they're going to make a profit. That's the way they're going to do it.
Yeah. So talking of which, the bigger credit card companies, the top two, are they collaborating in any way with any of these, besides on the entire wellness platform?
I think credit card companies are increasingly becoming very focused on
Yeah.
wellness because again it's because of where the market is going.
Okay.
They are probably developing stuff, but it's very early days for them. Remember, their core business is to lend money at high rates, right?
Right.
And they don't want to have things that cannibalize their business. So they need to figure out how to transition into a sustainable business potentially with a slightly different business model. And that the other thing is you can't generalize with credit card companies. You have prime credit card companies, you have subprime credit card companies. So depending on which part of which segment of the population they're servicing, they have different strategies.
Okay. Cool. So before I kind of my network kind of went off, I thought there was another question, and there was a person who wanted to ask a question. So sorry about this. I forgot to take his just it went off. Could you unmute yourself and ask the question, please? If he's still in the.
Yeah. Then what's the see? We're talking about the subject of financial and physical wellness. So it's very important that an individual stays afloat, balancing both. So in this trying and testing times, what is Udayan's mantra of, or Udayan's secret sauce of stress buster? Stress buster.
What's my stress busting secret sauce? I think it's meditation, yoga, and exercise.
You do that?
Absolutely. I think it's the most as I mentioned to you before, I think the people who really invented the holistic concept of wellness was all done in India through, yoga really shows the connection between the body and the mind. And that's what wellness is all about. It's managing the connection between the body and the mind. And that's where meditation comes in as well. So, it's very much around that. So I think if you wanna think about a holistic wellness, you need to manage all these aspects, and that's the way to do it. It's through meditation, yoga, and exercise.
Thank you.
Okay.
Thank you. Amazing. Thank you.
Thank you. So participants, before we wind up, would anybody else would want to ask a question? Because maybe I've lost the data that came along. So if there's anybody else would want to ask a question, please unmute yourself and ask a question. Don't ask about the source.
Your message for a work-life balance for the millennials.
That's an interesting question. I think the whole concept of work-life balance is now something that's becoming a real discussion topic, right? Because of COVID, and particularly as people went through this period working from home, they've started to assess what is important in terms of work-life balance. I think there are 2 or 3 things that have actually come out of this crisis. One is that there's probably working from home can be as efficient or even more efficient as working from the office. You don't always have to be in the office, and actually working from the office sometimes is very inefficient because of the commute time and the stress involved with the commute time. I think that then it also brings to the forefront that actually, because you had more time to organize your life, you also start to think very carefully about the importance of work-life balance. And I think employers themselves are starting to assess that, because this concept of managing more of a happiness index type of situation is becoming more important to people, because as you do that, you actually find that there's a massive correlation between the happiness of people and their productivity as well. So it becomes a very virtuous cycle. So actually, I think what's going to increasingly happen is that employers as well as employees are going to be very focused on managing the work-life balance and pushing people to have more of a on the life side of that work side balance, because actually productivity would then improve very much on the work side. So I think that's what's going to happen. I think the advice, of course, is that you have to be very careful to manage that, because otherwise it increases stress and burnout. And I even do that with people I work with. If I see somebody working too hard, I'd often say to them, listen, you need to really manage that, because otherwise you might end up, burning out too early. And this is not a sprint. This is a marathon. Life is more of a marathon rather than a sprint. So I guess that's my view on that.
Okay. I have a question from Ashwini Garu. So his question is, given the COVID-19 outbreak, majority dealing has become digital. So most of us deal with digital things. So the question, and as per the Indian psyche, insurance has predominantly been an agent-led service. And also more the transaction value, Indians have the apprehension of transacting via digital mode. How does you as a speaker see this evolution here onwards? Is that you're getting the question, Udayan?
Yeah. Look,
Okay.
I think the entire world has been agent-led, where you have insurance markets, right?
Okay.
But segment by segment, insurance is becoming a direct distribution model. So the one that's probably the most advanced in direct is auto insurance. Auto insurance in most markets are now has no agents, right? So UK, most of Europe, most countries I know are almost 100% non-agent led from an auto insurance perspective. Other types of P&C are also pretty much direct with no agents involved. Life has traditionally been very agent-led because it's a very complicated product. But the point around that is that as you develop more sophisticated methods of engaging with the consumer using digital channels, and I use the BXP example, which is in China, which is a very sophisticated way of engaging with consumers, you don't, that agent becomes sort of redundant, and there's no need for that agent to be in the distribution process. So I think rapidly the agent will disappear over time. And you're already starting to see the insurance regulator in India react to that by, before an agent could only sell life insurance and couldn't sell health insurance. Now agents can sell life insurance, health insurance. There was a time when you had the concept of tied agents, where agents could only work with one company. Now they can work with multiple companies. So they become more of a kind of trusted intermediary than the traditional sense of an agent. And even that, I think, will fall away as people will move predominantly to digital channels over time. And that comes back to consuming experiences and not consuming products. I think, you start to see that as well.
Yeah, thank you, Udayan. Thanks, Ashwini, for that question. So we have another question, and you talked about wearables, and I think that's being touted, like I said, as the next big thing. That's fine when you say that from my wristwatch, I can, I get a whole lot of data that can be mined and brought in. So the question is, what about free format data? Like suppose you are doing yoga or tennis. These are like free format data that's coming, and which is very important for underwriting.
I think we lost KK again, but I think I saw the question earlier, which was a little bit around how do you use free format data like yoga and others to be, in terms of underwriting. I think that's back to, you contributing that free form data into whatever platform if you're looking for a benefit back from that free form data. So for example, I track all my activity on a particular app. Now I don't share that with anybody. I keep that for myself because I'm trying to manage a little bit how I'm exercising and what I'm doing. But, if I wanted to, I could contribute that to an insurance company and say, hey, this is what my activity looks like. What does this mean for my premium, and can you reduce my premium? So I think we will see a lot of that increasingly as people start to manage their data in in a more sophisticated fashion and manage these data silos in a much more sophisticated fashion. So I think I think we're actually out of time, and I know I think KK is we lost him a little. Oh, KK, you're back. I was going to say
I'm back. Yeah,
I answered the question. I was saying we're a little bit out of time, but it was good to talk to everybody again.
Yeah. So I'm so sorry about this. That it's today it's like crazily. But anyway, we have come to our end of our show. We have passed the time. So, ladies and gentlemen, it's all about thinking of finance as a utility, a service that is continually available to support our overall well-being, whereby we have enough confidence in our ability to spend, save, and invest, so that we can fully engage with our day-to-day lives, jobs, and society at large. And the wellness part, which Udayan has so clearly explained, that's the transformation that's going to happen. And in India, we haven't seen much of it, but it's bound to happen. It's exciting time for us that we don't just hear commoditized products. We will get to see more customized product. And he gave very good examples of Ping An and Happy Money Reach. I'm sure there are a lot of companies that will come forward and provide us a kind of a repertoire of products which are suited to our individual needs. So with these words, Udayan, thank you so much. And
Thank
once
you.
again, my apologies for the, not able to connect for the full 1 hour. As usual, the discussing with you has been thoughtful, informative, incisive, and have a nice day. We hope to see you again soon. Thank you so much.
Thank you very much.